Hello, everybody, and thank you for joining today's Retirement Genius Brainstorm Study Group webinar. I'm your host, Chris Orestes, the president of Retirement Genius. And it's a pleasure to have you back every month, first Thursday of the month, where we take on new topics, challenging subjects, current trends, interesting guests. Our study group has grown now to over 800 people around the country joining us every month, and I welcome you and thank you so much for being one of them. What we're going to talk about on this session is the fiduciary imperative around life settlements and overall the fiduciary responsibility of agents and advisors. Retirement Genius is an information and resource hub helping people achieve a well-balanced retirement. We focus on information and resources around financial, health, long-term care, and lifestyle to bring those together into balance so that people can retire like a genius. And an element of this is never losing sight of our fiduciary responsibility to our clients. And what is fiduciary responsibility? It's what agents and advisors owe to their clients across the board when it comes to financial advice, insurance, any form of advice and helping people select the right financial solutions, products for them. It's about putting their interests ahead of our own. It's about making decisions that aren't influenced by what might make us the most money, but what's going to do the best for our clients. And an area that sometimes is overlooked as part of that fiduciary responsibility is life settlements, a transaction that you all know we work with. And I want to spend some time today going over how the fiduciary responsibility around life settlements is so important to know and to incorporate into what you're doing. We always want to make sure we're giving the best and most comprehensive advice possible, and it's a legal requirement. It's part of what keeps us in good standing with our licenses by putting that best interest of the individual without any self-interest or conflicts of our own into play. We always have to put our financial outcome second to our clients. So an insurance option that is too often avoided, whether it's on purpose or by sheer fact of not understanding or not being aware of the life settlement option, this is an area that is a key part of the insurance equation, and it's a mistake to avoid talking about it. And quite frankly, it's emerged over the last few years as an area where, for some advisors who avoided bringing up the life settlement option, at least informing their clients that that was an option that they could explore on their own if they wanted to, whether it was with their advisor or not, it's actually come back to haunt them, where some people have sued their advisors for not talking about life settlements as an alternative to lapsing or surrendering an unwanted or an unneeded policy. And I'm going to get into some actual legal precedents that have been established over the last decade I want you to be aware of. It's critical to remember that avoiding life settlements is a major error in your practice. On the one hand, it's a smart offensive strategy because it's another way to help your clients and it's another way to bring revenue into your practice. But it's also a very smart defensive strategy in your practice because at a minimum, you want to make sure you've checked the box and you've let your clients know that if they have a life insurance policy that they are considering lapsing or surrendering, that there is an option they can pursue through a life settlement to at least find out would there be a higher market value for their policy than simply lapsing or surrendering. And even if it's not something you're going to engage, it's not something you're going to work with, at least check the box that you made sure your clients knew that they knew about this option. And it's important because there's so many life insurance policies out there. We've got over 260 million policies that are in force in this country today with over 12 to 13 trillion dollars of death benefit. That's a lot of people walking around out there with life insurance policies. And the thing that kind of vexes the insurance transaction for the policy owner is how high the abandonment rate is. Nearly 9 out of 10 life insurance policies are in danger of being abandoned without paying a claim because they're going to be lapsed or surrendered. And so that's a huge pool of policy owners that should know that here's what happens if you lapse your policy. Here's what happens if you surrender your policy. Here's what happens if you settle your policy. For seniors, that market, which really is built for the life settlement transaction, remember, the older and sicker somebody is, the more they're going to get for their policy. For seniors, they own over $200 billion worth of life insurance policy death benefit every year that could potentially qualify for a settlement. And this has become a very mainstream financial solution. In the neighborhood of $4.5 billion a year of settlements are done in this country. You got to remember that life insurance policies are an asset, just like your home, legally recognized. And we're going to talk about that a little bit more. I want to drill down into that in a second. But it's important to remember that the two biggest asset classes that people own in this country are their homes and their life insurance policies. And just like a home where you're making mortgage payments every month, well, with a life insurance policy, you're making premium payments. Now, when you're done living in your home, what do? Do you drop your keys in the driveway and walk away? Well, of course not. You're going to sell your home for its market value. And the same option is available to policy owners to sell their asset if they no longer want to keep it. Why do people abandon policies? Well, really, it boils down to a couple simple things. One, people will outlive the insurable interest that they bought the policy for to begin with. Well, as they get older, their kids are now adults with their own children and their own life insurance policy. And that life insurance policy that was bought 10, 20 years ago isn't necessary anymore. That reason for buying it no longer exists. Sometimes it becomes an issue of affordability. People just get to a point, particularly when they're seniors, they're making some tough financial choices around their retirement budgets, the impact of healthcare, the impact of long-term care. Can you afford to keep paying those premiums? And so life settlements become a exit strategy that can then turn around and be used for things like paying for long-term care, adding more cash to be put into things like annuities, extending a death benefit through a retained death benefit settlement with no more premium payments. When you do a settlement, you're out of the policy, you don't have to pay premiums anymore, and you have a variety of options for what you can do with those funds to address the unique financial needs that have been brought on by the fact that the person is aging and their health is declining. This is a very well-regulated marketplace, and that's important to point out. Sometimes I'll encounter people who've been in the industry going back 20, 30 years, and they remember when the viatical life settlement industry first emerged. It was unregulated. Today, it's a very well-regulated. 45 out of 50 states have consistent regulations in place covering 90% of the U.S. population, where the departments of insurance regulate the transaction. There are consumer protections in place. There are standards in place. There are disclosure requirements in place. This is a very well-regulated market to match the fact that it has become so mainstream, with people seeing so many TV commercials and really having heard and seen information about life settlements now for 3 decades. This is a transaction that's been endorsed by legislative groups like the National Conference of Insurance Legislators, who've specifically endorsed life settlements as a way in particular to pay for long-term care. And the NAIC, the National Association of Insurance Commissioners, did the same, where they endorsed life settlements as a means to pay for long-term care and pointed out the higher cash surrender value that could be obtained than the higher settlement value versus cash surrender value that could be obtained as an alternative option for that policy owner. There's been legislation introduced on Capitol Hill over the years to incorporate life settlements into a specific senior health planning account that could be used to fund health and long-term care needs, making all the funds from a settlement tax-free and saving taxpayers billions of dollars. Don't be surprised if this legislation reemerges over the next year or two. It all boils down to this. Life insurance policies are legally defined as an asset, and that goes back to a Supreme Court ruling of 1911, where Oliver Wendell Holmes ruled that the possession of a life insurance policy is the asset of the policy owner, and they have the same personal property ownership rights as they would with any other asset, allowing them to sell that asset if they wish. But we have seen now, as I pointed out at the beginning, over the last 10 years, going back over the last 10 years, we have seen legal cases brought by policy owners against their advisors and insurance companies when they felt that the information about a life settlement was withheld from them, and they lapsed or surrendered a policy and then came to realize that they may have walked away from tens to hundreds to thousands to millions of dollars in settlement value based on the size of their policy. We have the Graham Bingham Irrevocable Trust versus John Hancock suit, which was ruled as violating Washington State's Consumer Protection Act. And John Hancock's appeal against this summary judgment was denied. They ruled that the idea that John Hancock was banning their advisor from informing them about life settlements was a violation of the Consumer Protection Act in the state of Washington. Grill versus Lincoln National Life. This is where the policy owner filed a suit citing that there was a determined common and systemic practice to not inform and in fact conceal from the policy owner the option of a life settlement, and that they sought damages against not only the insurance company but their advisor because this information was purposely omitted, and they let go of a policy and walked away from a lot more money that they could have qualified for by getting by doing a life settlement, which ultimately resulted in an out of court settlement. And then there was the Joseph versus Kay lawsuit, which followed the similar path of the fact that the agent was purposefully keeping the information about a life settlement away from them, and they were then found liable for compensatory, punitive, and treble damages, as ruled in California, citing things such as financial abuse of an elder and unlawful, unfair, and fraudulent business practices. So there is precedent on the books over the last decade of policy owners successfully holding advisors and insurance companies accountable for withholding information, not informing them about a life settlement. And remember, at the end of the day, it boils down to this: ignorance is no excuse for the law. At this point, anybody who says, well, I didn't know about a life settlement, I don't know anything about a life settlement, if you're an advisor, is not going to hold up. This has been common practice for 3 decades with constant information out there in the public sphere. And so, as I said, as a defensive strategy, as a minimum, you want to be talking about this as an option for your clients, if not participating in the market, helping guide them into a life settlement, and in the process receiving financial compensation. So what we've been seeing is with the realization of this fiduciary responsibility, more and more agents are adding life settlements to their practice so that they're able to protect themselves from the potential liability, but also benefit from a thriving market that is easily added to what they're doing. It's just another insurance transaction regulated by the insurance departments. There's nothing exotic about it. There's nothing new about it. It has been around a long time. It is common knowledge. It is a common mainstream practice. So what do you need to remember about life settlements? Well, remember, again, they're for seniors. This is a unique financial option because it will reward somebody with more economic value for the settlement of their policy the older and sicker they are. This is reverse underwriting. So if you are working with clients that aren't going to qualify to buy insurance, maybe a long-term care insurance policy, asking them if they have a life insurance policy becomes a smart strategy to use to meet their financial needs through a life settlement. This is a way to pay for long-term care. It's their legal right. There's no cost. Remember, it's important to point out that there are no costs associated with a life settlement whatsoever for the policy owner. And in fact, when they're done, they're relieved of paying premium payments. So you're putting money into the pocket of your clients on an asset they already own, they've already been paying into, and they're not going to owe anything. They're not going to pay anything out. You're not collecting premiums. I like to say, sort of tongue in cheek, this is free money for free, using an asset somebody already owns. There are tax advantages to life settlements, and the process itself is pretty quick and easy. It takes, I like to say, between 60 and 90 days. It can be done quicker. But it's good to sort of anticipate about a 60 to 90 day window to complete a life settlement. So I want to thank you all for joining today's fiduciary responsibility call session for our monthly brainstorm webinar study group. We'd love to get you a copy of this presentation. We'd also like to schedule a discovery call for you. Give us a call. Reach out to Heather Adams here. She's your key contact. This phone number and this email address. Let's make sure you're set up to use this program. Let's get the materials into your hands. Let's answer your questions. At a minimum, let's get this defensive strategy built into what you're doing. If not, let's give you the opportunity to take full advantage of this system. Our fee-based, no-load settlement. You don't need any special license. You don't have to be holding any special license to work with our system. And give this opportunity to you and to your clients. I want to thank you all for joining us again this month. We'll look forward to connecting with you again next month. We're going to push the start date out another week. But as always, once a month on Thursdays, typically the first Thursday of every month, the Retirement Genius Brainstorm Study Group webinar. We appreciate all of you who are members of the study group. Stay in touch, reach out. We really look forward to when we're talking to you again soon.